Market basics for normal people, not Wall Street. Let me tell you something most Americans don't realize until it's too late. The stock market was not built for you. It was built for institutions, for insiders, for people with access, leverage, and information speed you will never have. And yet, it is still the single most powerful wealth-building tool available to normal working Americans. That contradiction confuses people. They either fear the market or they worship it. Both reactions are dangerous. I am 84 years old. I have lived through recessions, oil shocks, inflation crises, dot-com bubbles, housing crashes, and pandemics. I've watched neighbors panic sell their retirement accounts. I've watched taxi drivers give stock tips at market tops. I've watched brilliant people stay poor because they were afraid to begin. And I've watched ordinary school teachers quietly become millionaires because they understood a few simple rules. This conversation is not about Wall Street. It is about Main Street. It is about you. If you are a nurse, a mechanic, a small business owner, a truck driver, a middle manager, a parent trying to build something that lasts longer than your paycheck, this is for you. Because the biggest financial tragedy in America is not market crashes. It's financial illiteracy. Most Americans do not understand how the market actually works. They think it's gambling. They think it's day trading. They think you need to beat the market. They think you need insider information. They think investing is risky. Let me correct that. Speculating is risky. Ignorance is risky. Doing nothing for 30 years is the riskiest strategy of all. The stock market at its core is simple. You are buying ownership in productive businesses. That's it. When you buy a share of stock, you are not buying a ticker symbol. You are buying a piece of a real company that sells products, hires people, earns profits, and competes in the real economy. When Americans misunderstand this, they treat the market like a casino. When you understand it, you treat it like farmland. Let me explain. If you owned farmland in Iowa, would you check its price every hour? Would you panic if corn prices dropped 1 week? Would you sell the land because a headline scared you? Of course not. You would care about long-term productivity. The stock market works the same way. But modern media has trained Americans to focus on noise instead of ownership. Headlines scream, "Market crashes. Dow plunges 800 points. Recession fears surge." Fear drives clicks. Fear drives ratings. Fear does not build wealth. Let's talk about what actually builds wealth in America. Compounding. Compounding is the most misunderstood force in personal finance. When you invest consistently in broad market assets, like low-cost index funds tracking the S&P 500, you are participating in the long-term growth of American productivity. The S&P 500 represents the largest publicly traded companies in the United States. Over long periods, not months, not weeks, but decades, American businesses innovate, expand, and grow earnings. That growth flows back to shareholders, not smoothly, not predictably, but persistently. Here is what Wall Street won't emphasize loudly. Time in the market beats timing the market. Normal people lose money trying to be clever. They jump in after headlines turn positive. They sell after headlines turn negative. They chase performance. They abandon strategy. Meanwhile, disciplined investors quietly automate contributions through 401ks, IRAs, brokerage accounts, and they let time do the heavy lifting. The average American household fears volatility, but volatility is the price of admission. There is no growth without fluctuation. If someone promises you high returns with no risk, walk away. That's not investing. That's salesmanship. Now let's address a painful reality. Many Americans over 40 feel behind. They earn decent incomes. They work hard. Yet retirement feels fragile. Why? Lifestyle inflation, rising housing costs, healthcare uncertainty, student loans for their children, inflation eroding purchasing power. And here is the quiet killer: delayed investing. If you wait until 45 to start seriously investing, you are fighting mathematics. A 25-year-old investing $500 a month consistently can outperform a 45-year-old investing $1,500 a month for decades. Not because the younger person is smarter, because time is the real asset. But here is the hopeful part. It is never too late to apply disciplined strategy. Let's break the market down in simple language. There are three main engines for normal investors: stocks, bonds, cash. Stocks are ownership in companies. Bonds are loans you make to governments or corporations in exchange for interest. Cash is liquidity, safety but no growth. Most Americans keep too much cash long-term because it feels safe. But cash loses purchasing power every year due to inflation. Inflation is not dramatic, it is silent. If inflation averages 3% per year, your purchasing power halves roughly every 24 years. That means doing nothing is a decision, and that decision costs you. Now let's talk about index funds. If you do not have time to analyze individual companies, index funds are your ally. An index fund simply tracks a broad market index. Low cost, diversified, no ego required. When I began investing decades ago, diversification was expensive. Today, any American with a brokerage app can own thousands of companies instantly. This is democratized wealth building. But technology has also created distraction, day trading, option speculation, crypto hype cycles, meme stocks. These temptations appeal to emotion, not discipline. The average retail trader underperforms the market because they confuse activity with progress. Let me give you a rule that has served me well for 60 years. If your investment decision makes you feel excited, nervous, or clever, pause. Wealth building should feel boring, predictable, structured, automated. Normal people do not need complex derivatives. They need consistency. You build wealth the same way you build muscle: repetition, stress, recovery, time. Now let's address market crashes. Every American investor will experience multiple bear markets. It is not a possibility. It is a certainty. The market has historically declined 20% or more many times, and yet over the long run it has recovered and reached new highs. Why? Because American businesses continue solving problems and generating profit. Crashes are painful, but they are also the mechanism that transfers assets from the impatient to the patient. During downturns, headlines amplify fear. People sell. Disciplined investors continue buying. This feels unnatural, but it is rational. If you believed in the long-term growth of American enterprise before the drop, why would you abandon it at a discount? That is the mindset shift. You are not predicting the next quarter. You are participating in decades of productivity. Now let's talk about retirement accounts. The average American underutilizes tax advantages. A 401k with employer match is free money. An IRA provides tax-deferred or tax-free growth. Tax efficiency matters. Two investors earning identical returns can end up with vastly different net outcomes depending on taxes and fees. Fees are another silent killer. A 1% annual fee sounds small. Over 30 years, it can reduce your final portfolio by hundreds of thousands of dollars. Low-cost index funds often charge less than 0.10%. That difference compounds dramatically. Normal people must become fee-aware, not paranoid, aware. Let me pause here. If you understand only this much, ownership, compounding, time, diversification, discipline, you already know more than most Americans. In part 2, I will go deeper into asset allocation, risk tolerance after 40, how to think about inflation in 2026, and why emotional control is your greatest financial advantage. And I will explain the biggest mistake I see middle-class investors make repeatedly. Now let me continue. Most people think investing is about picking the right stocks. It is not. It is about building the right structure. Structure protects you when emotions fail. Let's talk about asset allocation. Asset allocation simply means how you divide your money between stocks, bonds, and cash. This decision determines most of your long-term results, not which individual stock you choose. If you are 25 years old, you can afford volatility. If you are 45, you need balance. If you are 65, you need stability with growth. But here is the mistake many Americans make after 40. They become too conservative too early. They move heavily into cash because they fear another crash. But retirement can last 20 or 30 years. If your money stops growing at 65, inflation will slowly eat your future. You need growth even in retirement, not reckless growth, measured growth. Let's simplify this. A normal investor in their 40s or early 50s often benefits from a diversified mix such as broad U.S. index exposure, some international diversification, a reasonable bond allocation to reduce volatility, and a small cash buffer for emergencies. This is not exciting. It is effective. Wall Street thrives on complexity. Normal people thrive on clarity. Now let's talk about risk. Risk is not volatility. Risk is permanent loss of capital. Risk is running out of money at 78. Risk is being forced to work at 72 because your portfolio cannot support you. Volatility is temporary. Permanent loss is structural. If you own thousands of productive businesses through diversified funds, temporary declines are uncomfortable, but not fatal. If you concentrate your wealth into one stock because someone online said it would triple, that is risk. If you panic sell at the bottom because headlines scared you, that is risk. Emotional reactions destroy more wealth than recessions. Let me speak directly to Americans over 40. You have responsibilities, children, mortgages, aging parents, career pressure. You cannot gamble. You also cannot freeze. The middle path is disciplined investing. Automate contributions. Increase them when income rises. Rebalance once or twice a year. Ignore daily noise. Measure progress annually, not hourly. Now let's discuss inflation in 2026. Many Americans underestimate how powerful sustained inflation can be. If inflation averages 3 to 4% over long periods, and your savings account earns 1%, you are moving backward, slowly, silently, painfully. Inflation is a tax on inaction. Stocks historically outpace inflation over long time horizons because businesses adjust prices. Companies pass costs to consumers. Earnings grow nominally. Ownership protects purchasing power. Cash does not. Bonds partially do. Equities historically do best over decades. This is not theory, this is economic structure. Now let's address something uncomfortable. Many Americans want certainty. There is no certainty in markets. There is probability. Probability favors disciplined long-term participation. The longer your time horizon, the higher the historical probability of positive returns. The shorter your horizon, the higher the emotional risk. If you need the money in 12 months, it should not be in volatile assets. If you need the money in 20 years, volatility is noise. Time horizon determines strategy. Now let's talk about the biggest mistake I see middle-class investors make. They increase their lifestyle faster than their investments. They upgrade homes, cars, vacations, subscriptions, private schools. Everything expands, but their investing stays flat. Or worse, it pauses during good years because they feel comfortable. Comfort is the enemy of compounding. If you invest 15% of your income consistently for decades, you give yourself options. If you invest 3% and upgrade everything else, you give yourself stress. Financial freedom is not about income. It is about margin. Margin between what you earn and what you spend. The wider the margin, the stronger the compounding. Now let's address fear. Every cycle there is a new fear. Recession, election uncertainty, global conflict, debt ceiling, AI disruption, bank failures. There will always be something. If fear kept people from investing historically, no one would have built wealth. The key question is simple. Do you believe productive businesses will continue generating value over decades? If the answer is yes, then long-term participation makes sense. If the answer is no, then your problem is not investing. It is worldview. I have watched America change dramatically over 80 years. Technology evolves. Industries rise and fall. But innovation continues. Productivity continues. Human ambition continues. Markets reflect that over time. Now let me give you a framework. If you are starting from zero, build an emergency fund first, 3 to 6 months of essential expenses. Eliminate high-interest consumer debt. Capture employer 401k match. Then begin consistent index-based investing. If you are mid-career, increase contributions annually. Avoid lifestyle creep absorbing every raise. Diversify. Review fees. Stay disciplined during downturns. If you are near retirement, shift gradually, not abruptly. Maintain some growth exposure. Control withdrawal rates. Plan tax efficiency carefully. Normal people do not need to predict interest rates. They need to build systems. Systems remove emotion. Emotion is expensive. Let me close with this. The market is not a game to win. It is a tool to use. You do not need to be smarter than Wall Street. You need to be more patient than the average person. Patience is the rarest financial asset in America, and it costs nothing. Build ownership. Respect compounding. Control expenses. Ignore noise. Think in decades. That is how normal people build wealth. Not through secrets, not through shortcuts, through discipline and time.